Hey everyone, this is DayTraderRockStar, and I am back from vacation, and I'm going to do a market update video to start things off, and then I'm going to get my 10 for 1000 watch list out. We left off last week. I took the week of Thanksgiving off, but before I left, or actually while I was in Mexico, I threw out a little, just a little watch list video for this past week, and basically we knew that the market was suffering from a lot of news-driven events. There was a tremendous volatility in the market. Tremendous volatility. We had also the Thanksgiving week, holiday week, options expiration the week before. There was a lot of things that were really turning. And this is, basically the video that I sent out from Mexico. So I'm just going to recap this because this is where we left off last week, and then we're going to look at how the week progressed and how the video how everything shaped up according to some of the support and resistance lines and some of the channel lines here. So again, we left off last Monday or last Saturday here, the market pulling back. The stochastics up here were pushing down. We weren't quite in an oversold level yet, kind of very bearish here. It was a very bearish setup on the stochastics, especially when they're not oversold and they're kind of spread here, and the momentum is really driving down. And we had kind of a inside day pattern to the downside when this went out. So this was also a bearish setup. So again, I'm just going to scroll through the video. You're not going to hear any audio. You're going to see my mouse jump around because this is the video, and I'm probably just kind of showing you the 1, 2, 3 pattern here, a pattern within a pattern. Here's you have a downtrend line, and here you have a beginning uptrend line. So I was able to recognize that line and then probably put another line up under here to give us that 1, 2, 3 pattern. And you can see it right there. So that would come down to what we see here. Actually probably comes down to that 1083 level. And then we kind of outlined a 60-minute chart here, and again using the three pivot areas here to really determine that 1083 area down below us once again. So that's where we left off, expecting to move down. And this was the beginning of last week. We haven't hit Monday yet. Stochastics were also very negative. No real upturn there, and it kind of hugging the bottom line there. And this typically looks like a bearish flag. So everything pointed to the downside, and we just really wanted to make a mention of these lower trend lines. And what this video is really going to be about is timing in the market. And this is something that I think is very important, is that there's an old saying, the odds will eventually catch up with you, and odds and probability is what we want to be able to capture in the market. We just don't want to be able to have a random trade here. We want to have a probability trade where we have the most probability, or the most highest probability of a market moving in the direction that we know it's going to go. That way, when we base our trades, we're at an advantage. We know the direction of the trades. Now, of course, the market's been trending down, so the bears have been really profiting that. But even the violent spikes here in the market are very hard to deal with. And like I said, the odds are the market eventually is going to catch up with you. So why not? And that's the purpose of this video, is to explain why not trade when the market tells you have the best probability to get up what we call a trending trade. And when you have a trending trade or a directional trade where it's much easier to place your trades in that direction and to work your indicators. As things get very choppy, which they have been over the last few days, last week, then it becomes much harder, and you eventually get chopped up in the market. So we don't want that. We want to have the highest probability setups. That's why I always stress on the radio, high probability setups, even if it takes time. Even if it takes time for the stock to set up or the index to set up, you have to have those patience, because the market is set up. The market is so volatile and controlled by computers these days. And if you got to understand that there is high frequency trades out happening. You could see from a couple of weeks ago the violent 5 to 6 point moves in a minute in the S&P. I mean, these are very aggressive bounces, and you can't, these are computers that are trading this, and you're going to hear more and more about this high frequency trade, and it's very hard as a human. And I say that in a general, weird way of saying it, but as a human being, if you're not trading with a black box or some kind of algorithmic program to help you deal with the speed and the volatility of the trade, you're pretty much going to be at the mercy of these black boxes and stuff. So But one thing that these black boxes do and these algorithms do is they pick up the market at certain areas, and these are high probability areas. And they're not looking for tremendous gains. You know, the hundreds and thousands of contracts that are traded, all they need is a quarter point, half point. You know, small little trades like that add up real fast, and you get that a lot in this market. Now, can you adjust to that and trade that without the tools needed? I doubt it. You know, you'll probably get lucky every so often. And yeah, you could trade the market on a faster time frame. I'm not saying you can't do that. I'm just saying, why not do that when the overall market's giving you a strong high probability setup? So all these charts that you're hearing today could be broken down to the 60-minute charts, to the 5-minute chart, to 1-minute chart, to time your entries even better. So that's what's great about the high probability setup method. Everything converge. What's the word I'm even looking for? But transfers over to the right down the line. At 60-minute charts, the 5-minute time frames, everything gets just converted over to those levels. Converted is what I was looking at. So now we're going to take a look at where we are going into this week. And one of the important things we always talk about is having a stochastic setup. So remember, we draw that underlying trend line underneath that, representing the upward trend line. Now a parallel channel line pretty much gives us just an area to look at. Again, we're looking at higher probability setups, and how do we define that? Is by taking the oversold stochastics or overbought stochastics if you're looking at a high probability short area, and any recognizable other indicators, which I use, trend lines of a recognizable pattern, moving averages, 50, 20, 200. And a very important one, which I noticed on this chart, and I always want to point this out, and I think sometimes we kind of overlook this because the market is so, it's just so in depth and everything. We're looking at everything and all these indicators and volume and stuff. We kind of really miss the simple things in the market. And this is why, this is why high probability setups are so good. Because the simple things, when they do come in, they are higher probability of working out. And one of the more simple things are reversals on a daily chart. And how do you recognize a reversal? Well, one of the first thing is you want to have a switch in momentum. So you would love to have the stochastics at an extreme. We're going to take longs for an example here. Just reverse everything for shorts. So we want to have the stochastics in an oversold level. And then oversold is really, for me, for this video, we're going to call it underneath 20. All right, so we want that. Again, recognizable pattern. If we have an underlying trend line that's been extended all the way, say there's a line here and there's a line here, and wow, if you follow that whole line down, you could actually see that this area down here was a continuation of this plotted line. And again, you just need 2 points to make a line. And remember, when this area this is no reason why an algorithm can't pick this up, because if you have a point here and a point here and a point here, you could draw something just to, take your axes and your points and just, your angle, and you could, you could predict where this line is going to go. Just the way we kind of rip it out, and then when the price level gets down to it, we combine with the oversold stochastics, and combine with what we're going to call today is one of the best reversal indicators, are hammers on the candlestick. If you have all this tied up, you have a very good possibility of a continued move in a reversal or a start of a trend or something. Now, remember, the market is still volatile. It doesn't mean that it's going to happen overnight. You could see we came down to that trend line, we popped up aggressively, then sold off, and then popped up, and that's why it's very difficult to trade these markets. You need all the edge you can get. But now, this is the important part now. Look back at each time this market made a little reversal, or just a small change of trend. Not even here. This is not even. And when I talk about a change of trend, I'm talking about a move down to a move up, or a move up to a move down. So here we had a move up, move down to move up. Here we had a pullback all the way down to here, and then a nice violent move up. So we're going to take a look at some of these hammers as as areas where we had some big moves afterwards, and that's what we're looking for. We're not looking to, buy a stock and hold it for 6 months. We would love the best probability would be to buy a stock, get the reversal candlestick, and hold it for a couple days and get the maximum gain off of it. All right, and that could be easily done, but you have to have patience and look for these candles. Now, look at these candles again. These are just basically what we call hammers, and a hammer is just represents a long tail and kind of the body up on top. The smaller the body, the better. But in some cases, if you have a big white body, that's just as good. We really want to get the close as high as we can on a reversal. Some cases, you know, when we have a white candle versus a dark candle, if it remains, the body remains dark, that means the price still closed underneath the open. And again, if the body remains white, then we closed above the open, which is important. But you can see the longer the tail, usually the bigger the better the move, or the better the signal. So we look for those. Here's a tremendous tail here. All right, here was a nice tail here, and from that point on, we got a 3-day move. Here was a nice tail here, and we got a 2-day move. Here was a beautiful, and again, what we really want to see is the tail and the white body. That's what and the close, you know, within the top 10% of the move. So we really want to see this type of candlestick, a white body candlestick, you know, and closing that right at the highs of the day. And from that, usually you get a nice rally. Here was a candlestick. Nothing really happened on that one, but here's another very aggressive reversal candlestick, and you can see the rally from that. So now it brings us down to this point, and we actually have what we call a gravestone doji here. It's kind of the opposite. You have a tail on top and a close on the bottom. But this typically sometimes can show that there was some strength in the morning, and that means there's people willing to buy. But again, that was Friday, and that was, you know, that was nothing. That was a holiday session. I wouldn't count that. But what I would pay attention to now is the stochastics are oversold. We have the possibility of, you know, the upper trend line of a channel is here. All I want to see, though, and what's going to be my signal, is this candlestick. A nice reversal candlestick will be icing on the cake for a move back up here. And I think it's very important to wait for that and risk missing it, because you're not going to get, a lot of people get flushed out of this move. If we get a nice move down, boom, like this, and all of a sudden people are like bailing because they're thinking we're crashing. The next thing you know, that candlestick forms, and you know, we have that big hammer or that big head, and we close up here. You know, people are just scratching their heads normally and say, oh, I missed the move or whatever. But that's usually the beginning of the move, and then from that point on, so we could break down through here and reverse. That happens so many different times. The important thing is look for this candlestick. We'll see if it happens on any of the underlying trend lines. The stochastics are set up, and you know, and other than going into a time machine and predicting what the market's going to look like next week, this is going to give you your best opportunity in the market. You know, based on all the news, you know, we're still going to hear a lot coming out of Black Friday now, the shopping season. We have our Fed issues, our government issues. We're going to have Syria on the news. I mean, it's definitely Greece, Spain, Italy. So I mean, it's tremendous news out there. But overall, you know, I think this is just a, you know, kind of a technical setback. I don't think we're really selling off into this. It's not as aggressive as it seemed it could be. You know, the world collapsing around us, and yet we continue to kind of hold off recent lows. So I think the potential for a massive rally is still there. And when I say massive, you know, 200, 300 point days in a row to push us right back up. But let's continue to watch for that candlestick. I think that's the most important thing. We'll be able to measure that intraday. You know, we'll be able to see that candlestick. I'd be very cautious on anything too aggressive until you get that signal, because we want to be here long term. And this choppy, aggressive, you know, very choppy market is just, it is very, very hard to guess which way the market really wants to go yet. Again, we're going into December. We're going to go into what we call, you know, tax selling, but we're also going to go into end of the year window dressing, and you know, there's the Christmas so-called Santa Claus rally. So there's a lot of things out here. I'm not going to, you know, I'm watching for that candlestick. That's all I'm going to say. And, you know, I'm going to broadcast this each and every day. So we'll see this happen. And I'll send out an email when I do find, you know, that trigger, that major signal was set in the market. You're going to be the first to know about it. Anyway, that's the first of the videos tonight. I hope you enjoyed that. I'm going to get working on the 10 for 1,000 watch list. That'll be released probably around 10 o'clock tonight. It's about 11:30 in the morning now, and the 10 for 1,000 watch list goes out to all the members of the site, DayTradingRadio.com, and that, for those out there, represents the setups, the high probability setups we just talked about today. We transfer those over to stocks. We look for those high probability setups. I chart them out for you in a nice video format, buy triggers, targets, and it's usually the stocks we focus on during the day on the radio show. So, and you can listen each and every day at DayTradingRadio.com on the air about 8:30, and we go all the way to the end of the day. So, hope you get to join us. And for those out there and the members, I'm glad to be back. It was a nice vacation. But I'm glad I didn't have to be really too much of a part of, other than some of the stocks I was holding. But I didn't have to deal with the mental anguish of this market into this Thanksgiving. And I'm looking forward to getting back on the mic Monday. So I look forward to being back here with you. So I'll talk to you guys later in the next video.